Also with us, John O'Donohue, the head of equities at Cowen Company. Last time he was here, he, I should say, predicted the market is going to stay stuck for a while. It's not something we did all together. We were all talking about it together, but it was John's prediction. And John, what do you think about that? I mean, are we ready to move out of the range now, or do we continue to sit here until November?
I think we stay here for a while, Matt. You know, unfortunately, it does become a bit of a boring market. But if one can pick the tops and sell up there and buy the bottoms, it doesn't make for such a bad environment as a trader. So, if we look at where we are now, we got down to, I guess, what, 1050 or so on the S&Ps. The July lows were somewhere around 1010 or so, 1015. Capped up at 1125. It doesn't sound like anything too much fun, but within those bands you can actually make money. It's not the best for an investor environment, but it's more of a trading environment.
We can tell John is not having a bad week. But I wonder, Richard, I mean, and we hear this all the time, traders make the most money when stocks are stuck in a range, but is it more difficult, Richard, when there's low volume?
Yeah, it definitely is. It makes a huge difference. Down here, you know, we live and die by volume and volatility. You know, stuck in a range is fine if you're just playing it that way, but down here on the floor, with the advent of electronic trading, we've all had to grow accustomed to making money when the volatility and the volume's in, as we've seen this huge market drastic change over the last 8 or 10 years. So we really do need to see that volume and volatility come back in for us to make money down here.
Well, you say that as if you think it's going to happen. Do you think that's a possibility, or do we see a new normal in stocks as well, Richard?
I agree with John. I don't think it's likely that we're going to break out of this range. We saw 1100 set a really good ceiling for a while there, and we've seen the selling come in, a lot more aggressive selling than we see aggressive buying. Of course, today we saw a little bit of a bump there, but that was oversold conditions. So I think we'll be tight in the range as well.
John, are you concerned that people were fairly happy with Ben Bernanke's comments, and maybe they're on a bit of a sugar high because of an accommodative Fed, but in the long run, we still have a housing market that doesn't look healthy at all, a consumer that's struggling to pay a mortgage as well as obviously buy PCs now, and a situation in Washington where a lot of people on Wall Street think they're going to either do nothing or the wrong thing. Aren't there concerns long term still? Sure.
I mean, if you weren't concerned you know, at all, you'd be looking through, I wouldn't even say rose-colored glasses. I'm not sure what color they would be. But if you think back, and I know we talked about this a few weeks ago, and what I like to try and do, and being an old-timer on the street, so to speak, is I look at comparable or parallel times when situations were either dire or good, and try and draw parallel market movements over a period of time. And if you look back to this 1989 to 1991-92 period, we had a market that was post the 1987 crash. We had a market that the S&Ls had blown up. Real estate was down 30 to 40%. People seem to forget about that, but I happened to be a homeowner at that time too, and I remember it very vividly. And it took the market, I'd say, a good 3 years, 2 to 3 years of almost sideways movement before the economic environment worked its way through. Now, there are some situations right now that are different from that period of time. China is a much bigger deal than it was. In fact, it wasn't even a factor back in those days. Japan was the factor. But if I look at how things may pan out over time, my thought is that we're going to muddle through here for about 2 to 3 years. I understand, you know, a lot of the folks out there who make their living from selling either research or from selling newsletters and whatnot. They like to have this hyperbole that's in the marketplace, but I'm not a buyer of either of that.
John, I know you're not wearing a pink shirt, but we heard your phone ringing, your phone's ringing off the hook there in the last few minutes before the close. Is the flow coming in on names like, say, financials? You know, Bank of America bouncing off a 52-week low. You guys having any kind of flow in the financials today?
We do. We've seen some flow in the financials, and obviously it's not as robust, say, in the first quarter when these things were trading all over the place. But I would say this, that you know, you've got a group or a constituency of clients that move the paper around very quickly, and you've got a constituency of clients that are sort of much more sort of long-term thesis buy and hold. And what we've seen in the last few days are probably more of the buy and hold attitude here, that are taking looks at some of these super regionals, that are taking a look at some of the big money centers, because quite frankly, as you've seen a lot of this bad news hit the tape here for the last 2 or 3 weeks, And yes, some of the financials have dipped back down here, as you said, this third time in a row that they've touched the support line here. I think you are going to see some much more fundamental buyers step into into line here, away from what we've seen in the defensive stocks that you highlighted earlier.
Although, I mean, if you join the hyperbole crowd, John, maybe you could swing some more flow there. Let me ask you if you think that a certain generation has been burned. I mean, is there a demographic that doesn't want to go back into equities, that's had it and maybe close enough to retirement that it's just not going to happen, and as a result, we don't see volume really pick up the way we're used to?
You know, Matt, that's a huge question, because that's a question of just pure asset class allocation, right? So the move into fixed income has been sort of untoward, if you will. And I know I've heard some commentators talk about the fact that the proportion of fixed income assets in people's portfolio has not been appropriate, and this is just catch-up, and therefore the balance of fixed income in one's portfolio versus equities is getting back into the balance that it should be. I'm not so sure about that. I think, you know, over time, depending on the individual's risk appetite, the balance of fixed income versus equities will change. But having said that, I think you make a very good point. There's a generation that's been burned twice in the last decade, and I think trying to get them back into equities may be a harder sell than people do think.
Hey, Richard, it's Dominic here. I want to kind of bring you back in this discussion here, because one of the things that we want to talk about constantly is this idea of volume, right? It's just not there. It's the summer. Yes, it's August. People are saying it's going to pick up in the fall again. Is it going to pick up in the fall again, or is this like indicative of what Matt said, this idea that a lot of people may just not want to be a part of that equity market going forward here?
Yeah, you know, I mean, what I just want to point out, too, to follow up with what John's saying, is that it is still summer, and it really shouldn't be too much of a surprise that volume's low. I mean, August is typically the lowest volume month. We already had the earnings, everyone in New York's in the Hamptons. There's not a lot of action going on right now, so I don't expect there to be a huge increase in volume. Now, in the fall, after Labor Day into October, of course, there'll be some sort of bump in volume. How much, it's hard to say. And one other point as far as the generation that's been burned, you know, there's still financial advisors, there's still brokers out there trying to get people involved in the stock market, and they'll continue to do so. So I think maybe the self-directed business, the at-home trader, may have taken a bit of a decline, and it may take a long time for that generation to get more comfortable. But I think the broker trades and the financial advisors, those will still come back into swing.
Hey, you know, John, I just got 1 minute left, and I want to get your general thoughts on the Fed. Does it have the ammunition, if we see a big QE2 coming around the corner, to do what it needs to, or do Washington's policies really just need to change?
If you read the back page of the New York Times today, it was very interesting. It was the juxtaposition of an article by Dave Brooks versus Krugman. And I think what's happened right now is you've got these enormous policy differentials going on between the sort of the sugar high, as you mentioned, those continuation of spend and the QE, versus those that say, look what Germany has done, look how you know the early stages coming out of this, plus what's going on in the United Kingdom and stuff like that. I think the Fed has enough ammunition to do whatever it wants to do. It's just a matter of whether, in fact, from a policy decision-making, that where they come down on this. I think ultimately what's going to happen is November is going to be very telling as regards what policies are followed following that election.
All right. Hey, John, thanks so much for joining us. John O'Donohue there from Cowen and Company. Rich Regan also joining us from ProTradingCourse.com.